our team member. Firstly is Nazatu Ayuni binti Azmi. Secondly is Shashana Bila binti Suhaili. Thirdly is Nofar Shamimi binti Abdul Aziz. Fourthly is Umi Alice Fitri binti Amran. And lastly is me, Nomashita Naila binti Zulkifli.
So what is the definitions of banking and financial institutions? Banking and financial institutions are organizations that offer financial service such as investment products, loan approval, deposit acceptance, and payment processing. The financial of the system are regulated, controlled, and governed by the institutions that make up the financial system. It uses inputs to make outputs, which are the financial service itself. Commercial bank, credit union, investment bank, and insurance providers are among them. Commercial banks are the most significant financial intermediaries because of their primary functions, which is to accept deposits of money from individuals, business, and government agencies, so that they can invest the money and make the profit through a lending and other financial transactions. How it relevance in current economic landscape? These institutions are necessary for supporting financial stability through mechanisms such as reserve requirement, lending regulations, and stress testing. Banking institutions serve as safeguards against economic shocks. Second, by promoting economic expansions. Banks facilitate economic growth by offering mortgage and personal loans, allowing consumers to invest in homes, education, and durable goods. Third one, enabling regular financial operations for both individuals and companies in the current economic climate. On a day-to-day level, banks enable foreign exchange services that support global business activities. Without these foundational services, modern economies would not function efficiently. The importance of banking institutions are growing into fields like fintech, digital currencies, and sustainable finance as economies become more technologically connected.
Thank you for the previous presenter. Now I proceed is why this issue is significant in the field of taxation, because banks facing a financial pressure tend to rely more heavily on tax planning strategies. When banks do not have enough financial flexibility, they look for a way to legally reduce their tax payment in order to save money and manage their limited resources more actively. These strategies help them lower their cash effective tax rate, meaning they can pay less tax in actual cash term. This also found that this behavior is not a short-term solution, which is many banks continue using tax planning technique over time, making it a consistent part of their financial strategy. This shows that tax planning become more important for banks when they are financially stressed. This highlight was important the role of tax authorities and regulators in monitoring how banks manage their tax, especially in challenging financial situations. It also suggests that financial constraints can push institutions to be more creative or aggressive in their approach of tax planning, which can have a wider effect of government for revenue and fairness of the financial system.
Now, let's take a look at how the taxation issue can affect the various stakeholders. I'll be divided the stakeholders into three categories, which is the first one is government, the second one is the companies, and the second one is the consumers. For the governments, they will get a very wide tax basis, and then also they're having a higher revenue to reduce any deficits, and then but the government must also calibrate to avoid to burden the middle or low income percent. And then for the companies, they may having a leverage incentives that is more low cost. They should have a invoice and automations, but also they need to accelerate the dividends payments. And for the consumers, luckily the basic essentials are being protected from the SST, but the price for most goods and services are being rises. So this actually has been gathered from the budget 2025.
Regulators such as the European Central Bank, which is called ECB, have found that banks do not have the right system and also data to measure and also manage these risks that make it different from regular financial risk in that it's complex and also a long term. But some regions, which is like the UK and also the EU, are making progress, but many others are still struggling due to a lack of consistent regulation and also the standard. For the second point is, as technology evolves, banks need to change the way they operate internally, like staff roles. For example, the role of a universal banker is becoming common where staff can assist with both tailored services and also more advanced financial advice, and also they need to focus on hiring employees, which is both online and also in-person customer need. And the last one is security remains a key concern for banks due to the increase in cyber threat and also data breach. To protect customer data, banks use such as address verification service, which is we call EVS, to verify card detail, and also end-to-end encryption, which is we call E2EE, to secure communication. This tool helps stop fraud and also unauthorized access, but banks must continue to update their system to stay ahead of new threats.
The future of the financial and economic ecosystem is being shaped by several key developments. Firstly is the rise of cyber risk and financial crime by pushing institutions to adopt stronger threat-driven security measures and regulatory framework to protect the consumer. Secondly is data integrity and analytics that are becoming very crucial, as a financial institution must manage and use reliable data effectively, especially in online banking that introducing new privacy and competition challenges. Thirdly, banks also should embrace the technology like AI, blockchain, and cloud platforms that require upscaling workers and adapting to automation. In summaries, the financial industry must evolve quickly, balancing the innovation with the security, data responsibility, and workforce transformation to stay competitive in this digital era.
It is important because financial institutions play a key role in managing money, which is credit and also investment within the economy. For taxpayer, it helps in understanding how income is reported and also taxed. For example, interest from saving or investment is taxable and must be declared. Banks are also required to report certain transactions which are authorized to prevent tax evasion. While many financial services are exempted from tax like SST, some fees may still include tax because it's affecting banking costs. In conclusion, it helps individuals comply with that law and also manage finance more effectively.